So no, it was actually the attraction of working with good people. And to be honest with you, that's how businesses should set themselves up nowadays as well. I mean, we all know about the well-being elements and indeed the very strong ESG credentials that businesses have to display if they want to attract the right sort of talent. But it's not only those elements that attract people to businesses, it's the kind of people that they're going to work for and indeed how much they're going to learn. Ultimately, it's about resource at the end of the day. It's about being able to turn on and off that tap when you need that resource, but also working with good people. I mean, I'm pleased that I've been able to hire someone just recently, but that was quite a long and complicated process. So finding the right talent at the moment is incredibly difficult for numerous reasons.
Welcome to the People Property Place podcast. Today we are joined by Richard Saul, Head of Asset Management and Development in the UK at Ivanhoe Cambridge. Ivanhoe Cambridge develops and invests internationally alongside strategic partners and major real estate funds across dynamic cities around the world. Through subsidiaries and partnerships, the company holds interests in 1,500 buildings, primarily in the industrial and logistics, office, residential and retail sectors. As of the 31st of December 2022, Ivanhoe Cambridge held 77 billion Canadian dollars worth of real estate. Richard is responsible for driving value across Ivanhoe Cambridge's UK portfolio, and he's previously held roles at Lendlease, HB Reavis and CIT. Richard, welcome to the podcast.
Thank you for having me.
Not at all. Well, look, we'll come on to Ivanhoe Cambridge a little bit later in terms of our conversation, but yeah, the score here is how did you kind of get into real estate and why did you want to pursue a career in this space?
So probably not the most imaginative of answers, to be honest with you, but I'm quite old school. My father was a chartered surveyor and I've always had an interest in design and buildings, but got to that sort of crossroads and thought about where am I going to go. And he suggested I should go to Bristol and do what it's called valuation and estate management, which was a BSc. And at the point in time, I couldn't actually think of anything better to do. So I knew Bristol very well. Amazing city, very lively city. It's actually changed remarkably since I was there, which unfortunately was quite a long time ago. So set myself out on the path then to go off and do a degree in real estate, which is probably less common nowadays than it was back sort of in 1992.
Did you kind of ever grow up thinking, I don't want to do what my dad does? Or was it a case of, that's interesting, and have intellectually stimulating or creative conversations around the dinner table, and you think, actually, I could do that?
No, I'd always had an interest in buildings and sort of the design of buildings. My father was, he worked for the valuation office, was relatively senior in the valuation office, so dealt with all matters to do with rating, which at the time was actually quite profitable area to be in, and still is, so I'm led to believe. But it's quite binary. So no, I always sort of held an interest in sort of how buildings worked and who occupied them, but never really wanted to sort of go in and completely emulate what my father did. But of course, that introduction and going to Bristol, which, as I said, is a city that was going through enormous change and has continued to go through enormous change, sort of introduced me to it and then sort of opened my eyes to it. Plus, I had an amazing time when I was at Bristol as well, although unfortunately a lot of my peers from Bristol are no longer in the real estate business. But it was 3 amazing years.
So you went to Bristol, did your degree. Then what happened? What was your mindset kind of post-graduating?
So I graduated in 95, which if people can cast their minds back that far was not great for the employment market. So I think I kind of potted around for a little while doing odd jobs. Then actually went to work for the valuation office for a little while, which was purely just to sort of get a footing, and then ended up finally landing a role at Nelson Bakewell.
Which at the time was kind of one of the leading independent practices, right?
I mean, we were chatting before this, and the way I was going to describe Nelson Bakewell with very fond memories, and in fact, I suspect there's a huge number of people in the real estate industry, although probably erring on the over 40s, who worked at Nelson Bakewell. And we talk a lot nowadays about attracting talent. And Nelson Bakewell had a very an amazing skill at attracting talent. People tended to, there was some people who had, relatively long careers there, and I'm still friendly with some of them. Alan Dornford in particular, who I had breakfast with the other week. But they also had quite a significant sort of throughput of people. But the 2 years that I spent there was enormously enjoyable with some really good people. And their ability to attract talent, it was a very much a work hard, play hard kind of atmosphere, which as a sort of young APC surveyor was quite attractive. And as I say, it's some very interesting people who've gone on to do some weird and wonderful things since leaving Nelson Bakewell. I mean, Nelson Bakewell was, at the time, both Nelly and Bakewell were still sort of there. It was transitioning away from them and transitioning more from a transactional business to a management business, both on the landlord and on the corporate side. So it became a business that I guess was driven more by reoccurring revenue rather than the revenue generated by doing deals. But in terms of actually attracting talent, as you would call it now, it had quite a skill set. It didn't quite retain the talent, but...
I'm always interested, obviously, in the space that I am, in terms of how companies go about attracting talent and, of course, the retention piece. We've got lots of tools at our disposal now that you didn't have back then. But can you just talk a little bit more in terms of maybe what was their secret sauce in terms of attracting?
I think it was just the mentality of the business and the fact that they had some really nice people who worked there, again, knew how to sort of work hard and play hard. And back then the industry perhaps was more stereotypical in terms of the play hard elements as well. I can see you smiling at me.
Gone are those days, aren't they?
Well, yeah.
Or they're more regulated.
Yeah, they're not completely gone, but yes, they're not as frequent. So no, it was actually the attraction of working with good people. And to be honest with you, that's how businesses should set themselves up nowadays as well. I mean, we all know about the well-being elements and indeed the very strong ESG credentials that businesses have to display if they want to attract the right sort of talent. But it's not only those elements that attract people to businesses, it's the kind of people that they're going to work for and indeed how much they're going to learn. Throughout my career, I've always looked back and thought, right, what did I learn there? And indeed gone into roles thinking, right, what can I not only achieve financially, both for myself and the business, but also how much can I learn in this business?
So you touched on you with Nelson Bakewell a couple of years. Did you get your letters?
I did.
Passed your APC?
Yeah, passed my APC. Yeah, I shan't tell you what I did for my celebration.
Well, what in terms of rotations? Did you rotate, or did you kind of just do your valuation seat, or?
So, I mean, they didn't even really do valuation seats then. You just had to do your diary as it was then, and you had to do, I think it was 60 days in valuation, and then I did professional services, which was a mixture of rent reviews and rating. So because of my experience with the VOA and the fact that my dad was also a district valuer, I had a high degree of experience in rating, which is actually quite primarily you were negotiating rating appeals. And so there was a huge amount of negotiation. And so you pick up that skill of negotiation doing that particular discipline. As I say, it's not a particularly sexy discipline, no disrespect to the guys who do it nowadays. But as I say, I believe it's very profitable still. But what it did teach me was how to negotiate, which is something they don't teach you at university.
And what were those skills, and how did they train you, and what were the kind of the learnings that you extracted from those negotiations?
Well, it's to be able to be confident about your case, set out your case clearly, know where your strengths and weaknesses are. I know that's a very obvious statement. It's also trying to ascertain what your counterparties' weaknesses are. If you're doing it face-to-face, you might even try and work out their body language and see sort of what messages you're getting from their body language. I actually prefer, and even in this day and age, face-to-face meetings as opposed to Teams, because I find it very difficult to read people on Teams, whereas I try and read people when I'm negotiating face-to-face. bit of a skill set that's perhaps being lost over the last decade or so, but negotiating a lot on the telephone, doing quite a lot of business on the telephone, which I've got a good story about Edward Charles and Partners about that. So yeah, it's genuine, or generally just being confident in your case, knowing when to concede points as well. There's no point in sitting there with an argument that just simply isn't tenable, and trying to defend that, because you won't actually reach a resolution. So ultimately, what I think I'm trying to say, it was the art of trying, sound a bit like Donald Trump now, trying to do deals.
Win-win, create win-win-win opportunities for all parties involved.
At the time, negotiating rating appeals, your fees were success related. So yes, unless you thought you had a real point that you wanted to take to tribunal, you're always trying to broker a deal, and you want to broker the deal to do the best for your client, but also you broker a deal, it's a good deal, you can bill a fee and move on.
Edward Charles and Partners. Talk to me about who are Edward Charles and Partners.
So Edward Charles and
why
Partners,
did you move there?
That's a very good question. Why did I move there? I think I became very friendly with a guy called David Fryman, who was their head of landlord and tenant. And given the sort of experience I'd had at Nelson Bakewell, I developed an interest in rent reviews, lease renewals, and also the wider West End office market. I used to live in just outside of the West End. So I was offered an opportunity to go work there, primarily working with David Fryman. A very, very small team, I guess, still going extremely strong. And in fact, some of my best friends in real estate are now equity partners in that business. But I had a strong interest in the sort of more professional side of leases, as I say, the rent reviews and the lease renewals. But Edward Charles and Partners gave me the opportunity to go out into the market and also do what now is probably more widely referred to as leasing brokerage, but in those days was just good old-fashioned agency, trying to lease premises and also doing some acquisition as well. Back in the early 2000s, in fact, it was 2000 when I joined, the teams tend to be a little bit more joined up at that point. You didn't have separate sort of acquisition and disposal teams. And indeed, Edward Charles and Partners was a relatively small business. So you were given exposure to both sides, both in terms of acquisition and disposal, which when you're trying to negotiate a rent review, A, gives you greater access to market evidence, and B, gives you a sort of a more broader perspective on this hypothetical transaction that you're trying to negotiate again with a counterparty, whether it be for a landlord or a tenant.
So kind of like really knowing your market, really understanding the drive, the basic stuff that comes there, but also just the quantum of stuff that you're seeing.
Immersing yourself in the West End office market, which at the time was, hugely enjoyable.
Have you ever viewed, that experience as like skill stacking? And what I mean by that, the negotiation stuff you learn from a rating perspective, directly feeds the next part of your career in terms of like leasing, letting, doing transactional deals. There's a skill that you can apply there. And then once you've built that knowledge, it's how do you apply that and use it from a kind of an LNT rent review perspective?
There's undoubtedly that element to it. I think, if you move forward many years in terms of what I do now, that transactional experience and that market-facing experience pays huge dividends in terms of what it is I'm trying to achieve now, and the goals that I set myself and the goals that Ivanhoe set for me, and indeed our corporate goals, because ultimately at the end of the day, we are a pension fund that invests in real estate, and we generate returns for our shareholders and our pension fund holders back in Quebec through adding value. And that could be done by different means, whether it's development or whether it's a good old-fashioned way of actually generating property return through income.
I guess at the time as well, from a network perspective, you probably developed an amazing network just by the speed and quantum of transactions and deals that you kind of went through, but also the amount of people that you met along this journey that, taking a long-term view in terms of your career, are paying back now. I know you mentioned kind of Alan Dunford at was Chelsfield, now Bridgemont.
That's right.
That's probably a case in point in terms of a relationship built over 20 years or so that may or may not transact in the future. I've got no idea. At what stage did you think, actually, I want to make the move to the principal side, and actually asset management is a part of this sector that actually it suits me from a personality perspective, but also an interest, skill set, and financially as well?
So I had four and a half, five very enjoyable years at Edward Charles and Partners, but we, I guess, primarily acted for landlords. We did quite a lot of work for occupiers as well, but as I say, those two sort of elements of the work sat side by side, so you were exposed to both. But we did a lot of work for Threadneedle, as they were known at the time, and I became quite close with a number of the senior guys at Threadneedle, an individual called Rob Flavel, who I've not seen actually for donkey's years, but he approached me and asked me whether or not I wanted to potentially go and join Threadneedle. Now, at the time, this was about 2004, the West End office market wasn't as good as it perhaps has been. And so I was very cognizant of the fact that Edward Charles was a small business, and you're always looking for potentially what comes next, but also with an eye behind you thinking, well, it is a business that's based purely, its revenue is based on deals, and if that deal flow dries up, then of course, the one thing they may look at is cost cutting. So I was approached by Rob Flavel at Threadneedle. Obviously I had to go through a process, but effectively to join Threadneedle as an asset manager, which I sort of grasped that opportunity with both hands.
And at that stage, was that a combination of like utilising all these skills, negotiation, leasing, investment work, the rent review?
Yeah,
piece?
Threads was very much a hands-on, quite granular asset manager.
Even though it was a fund?
It was a big
manager?
fund, yeah. So I was working with an individual called Daniel Ward, who was a very colourful individual, and a chap called Link Horton. Working on was an old equal star fund. So some fairly dirty, not literally, but some fairly messy assets. So you could really get your hands dirty. Some of a reasonable size, but a huge quantum of assets. I think I had probably 100 or so assets under management. And it was that cross-section of sectors as well. So Threads at the time invested in some shopping centres, quite secondary, tertiary shopping centres at the time, but retail hadn't gone through the sort of structural challenges that obviously it's been facing for some time now. Industrial estates, as we used to call them then, and offices. But throughout the UK, but again, given my Edward Charles and Partners experience, I was lucky enough to deal with sort of West End offices, or the West End offices that the fund that I worked for had within its portfolio.
And have you always had like an affinity to offices and an intellectual interest in the economics and the return profile, and being in the West End, you're surrounded by them, as opposed to retail or residential?
So Threads at the time had no residential, very little. So wasn't really exposed to residential, and obviously it was well before the sort of multifamily and build to rent sort of revolution that we've been witnessing in the UK. So offices were primarily my first love, having worked at Edward Charles and Partners and built up a huge sort of knowledge base and contact base. And at that point in time, you wanted to continue to grow that. So I wanted exposure to that. I guess as well, I became really interested in refurbishment and the design and how you could actually repurpose offices. We didn't do big scale or large scale redevelopment, but it was about repurposing some offices in the West End and indeed sort of big 7 cities. We did a bit of stuff in Bristol, Birmingham, a bit in Leeds. So again, working out and looking at appraisals as to how CapEx really added value as well. So rather than just being one element of that process, which was at Edward Charles and Partners, transacting a rent review or executing a leasing deal, which is sort of more towards the back end, it was getting a broader perspective on the whole piece from inception to completion.
So you were with Threadneedle for about 5 years or so. Who was CIT? How did that come about? And also there's a bit of a step change from moving from an asset manager at Threads, as you said, kind of touching on that quite wide-ranging skill, to being a director. Can you just talk to me about that experience?
So again, it was one of those pauses, kind of a bit of a natural pause, having spent 5 years at Threads, thinking, where can I potentially take this skill set and continue to grow it? I was introduced to CIT, which is a private equity business, had actually raised and invested significant sums in a UK fund, primarily into offices, one big shopping centre as well, which I'm pleased to say I didn't deal with. But it was a sort of a natural progression of my desire to continue to grow and evolve with the office market. I wanted to deal with bigger toys, and CIT had a number of big toys within their portfolio, that it was purely an asset management role. As I say, it was a closed-ended vehicle, highly leveraged at the time, as everything was in sort of 2007, 8, 9, and so on, as people know. But it was that opportunity to take that skill set and then to apply that skill set to big buildings. Templey Place, which actually remains one of my most favourite buildings in the market to this date, designed by Skidmore's, which is an amazing office building, just remarkable external design, and how we could continue to evolve that building, dealing with tenants, working with your customers, not tenants, and how you could generate value by actually collaborating with them, whether it be re-gearing leases, understanding their needs where they might need to shrink, and indeed where you could engineer situations with tenants where you move them around the building. Very focused on income, primarily because of the situation that the fund found itself in. It was a closed-ended vehicle.
So someone listening to this who doesn't know what a closed-ended vehicle is, can you just explain that? Because it's a PE term, isn't it?
On the whole. So a closed-ended vehicle is a fund that's raised for a finite, so you raise your capital, and then the fund has a finite life, where it'd be 3, generally not, but mostly 5 years. And then at the end of the 5 years, the investors in the fund can vote typically for an extension, 1 or 2 year extension. And if the investors don't vote for that extension, then the fund has to divest of the assets and return the capital to the investors. Of course, the principle behind that is that you make a return for your investors within that 5 year period. So once the investors have actually invested into the fund for the first initial investment period, which, as I say, is generally 5 years, they're unable. It's not a retail fund, so you can't take money in and out within that closed-ended period.
It's locked in for that period.
Pretty much.
It's the discretion of the investment manager of the private equity business.
Yeah, there are different ways of doing it, whether it's semi-discretionary or discretionary, but at CIT it was pretty much a discretionary vehicle.
And in terms of the capital behind that vehicle, was it high net worth individuals?
No,
was
it was
pension
raised
funds?
from
Was it private equity, other additional private equity?
No, it was raised all over. Some overseas pension funds. I think Franklin Templeton, who I'm not in contact with, but they were investor in it. So no, it was sort of a
commingled.
Yeah, it's not a club as such, because it was raised as a standalone fund. I think it had about 200-300 million pounds worth of equity committed to it. But no, a sort of relatively broad cross-section of investors. I think NatWest property investors might have had some money in it. So again, it was raised off the back of CIT's very successful track record of executing sort of private equity style deals, of buying assets, holding them, executing the business plan on a highly leveraged basis, and then exiting and returning significant returns to the investors.
In terms of like a culture, that compared to Threads, stark difference?
So it was much smaller, both very entrepreneurial, both run by quite big characters. So no, a lot of the skills that I learnt at Threads were easily transferable into CIT, but what you had to have with CIT, you were dealing with much bigger lot sizes, bigger buildings, bigger sums of money. So it's that confidence that you've gained at Threads in dealing with smaller lot sizes, smaller deals, smaller leasing deals, perhaps smaller capex strategies, smaller refurbishments, and taking that experience and that confidence and transferring it into something where you were doing, to a large extent, the same job, but with much bigger numbers.
Yeah, more zeros at the end.
Exactly.
Had more to lose or gain, depending on which way you looked at it. You spoke a lot previously about the relationship and tenants, and casting our eye back to that period, 2009 to 2013. Was that, would you say, the start of that kind of, customer relationship between landlord and tenant, or was CIT very much on the kind of the front foot in terms of kind of trying to drive that relationship rather than just be an old landlord that's leased a building to a tenant for 25 years and collects rent checks every four times a year?
Well, you to some extent you had to be, because there was obviously a lot of distress around sort of post the global financial crisis. And, I'm not ashamed to say that, we at CIT, we had a number of buildings where we were not only working for our investors, but potentially for some of the banks as well. But the key to keeping investors and banks on board was cash flow. And who generates that cash flow for a real estate investor? It's your clients. It's the people who pay you rent. So, and clearly they were going through significant sort of distress as well. So being close to them, understanding their needs was key, but also ensuring that cash flow, the contractual cash flow that is due under the lease, continued to flow. We all had sort of interest and amortization payments to make to the banks because of the fact that these things had considerable leverage on them. But ultimately, it was down to the asset manager to ensure that cash flow continued to flow into the funds and was able to service the debt. So building that relationship with your customers at that point was key. I think it was born to some degree out of necessity because of the global financial crisis and the distress that property was suffering. Valuations were just catastrophic. So with the key element to maintaining these assets and keeping them afloat was cash flow.
I guess that applies across all sectors. And at the time, probably everyone's doing exactly the same thing, just to try and maintain that income and get through recapitalizations or restructuring of their business to make sure that they could press ahead in the best shape possible, or give the keys back to the bank and move on.
Yeah, at the time it was just trying to preserve as much value as you could for your investors. I don't think, with valuations and the levels of distress and the lack of liquidity in the market in terms of the capital markets, no one was sort of, at least we weren't daft enough to think that, we were going to be making a huge return for our investors. It was about returning as much equity as possible.
Was that the second time that you'd been through a challenging period in the property space, just from a cycle? And had you kind of learned anything that set you in good stead to kind of ride through that period off of that early period as well?
That's a good question. I mean, the first period of turmoil that I experienced was probably the dot-com crash in 2000 when I was at Edward Charles and Partners, but that was so sudden and had such a fundamental impact on the sort of the office market. I don't think anyone had seen anything like that for quite some time. And then, of course, unfortunately, September the 11th happened as well. I can actually remember where I was. But the far-reaching consequences of the GFC in that it effectively infected, for want of a better word, all sectors to the extent that it did, meant that we were all learning from each other. I was learning new skills. The Threadneedle was a fund, or the funds within Threadneedle at the time, the majority of them were institutional funds, so they didn't take debt. So again, you were learning new skills in terms of dealing with lenders, who to a large extent became your clients as well, because you were working to service the debt as well as working to try and return as much capital to your investors as you could and keep the properties afloat. So there was a little bit of learning on your feet at that point, but the core skill set of actually asset managing was something that remained sort of constant, and that piece of engaging with your customers. Of course, rightly or wrongly, environmental standards were perhaps nowhere near as stringent then as they were. We weren't talking about sort of ESG as one of the pillars of your investment thesis. I think, again, at that point in time, it was more about the location and the quality of the space, which feeds into the well-being attributes and what makes space attractive to your clients. But no, a lot of it was primarily down to sort of location, and indeed some of it was potentially down to who the owner was and the identity of the owner, and perhaps how clients felt about and how easy it was to deal with some owners, or not, as the case may be.
In terms of what, letting the space, or
letting the space, or perhaps how shall we say, punchy some owners were at that point in time. Of course, at a time of crisis, you have to be pragmatic.
Yeah. Talk to me, because I know one of the reasons why you got into real estate was for kind of the design aspect. Did that ever come into the frame at CIT, that interest in design, or was that maybe a little bit more prevalent when it comes to HB Reavis and your move to that business?
So CIT had two arms. It had an asset management and a development arm. So when I was at CIT, I was lucky enough to be there when they kicked off South Bank Tower, which was the old, I think it was an IPC tower, down in SE1. So again, there was taking that sort of market-facing experience, what tenants want, product definition, as I sometimes call it. So feeding into the development brief was something that myself and the development team looked at quite strongly with the leasing agents as well, because the leasing agents and the leasing brokerage teams have a very important role to satisfy at the front end, as well as trying to introduce prospective clients and then helping us as a developer and a landlord close those deals. So yes, there was a lot more done at the front end in terms of what is it that our customers actually want out of these buildings.
Did you ever think of transitioning out of asset management and being a bit more investment focused, or because a lot of people do, did you kind of see yourself as your skills, your personality really lends itself to being a really excellent asset manager, and actually it's best to kind of double down and be a subject matter expert in a particular niche and own that?
Yeah, I think once you start building up sort of a track record, which is something that I believe I'd started to build up, and you build up a series of market contacts. And of course, everyone, when they started real estate, at least it used to be the case, is, I'm going to be an investment agent. Well, probably highly unlikely. I don't have the stats to back that up, but I'd say it's probably highly unlikely. And what I came to realise, and I think a lot of people come to realise now, is actually it's more of a joined up process now than perhaps it was in the past. But in the past, it might have been seen to be a little bit siloed, whereas now it's certainly the way we operate in the UK at Ivanhoe is it's a much more joined up process. I'll give you some examples when we get on to talking about Ivanhoe, how the asset management and investment teams have actually worked very closely together, also with our corporate teams and our head of strategic partnerships, in terms of closing a deal that was a multifaceted deal that required different disciplines. But ultimately it was one deal, but that different disciplines had to feed into it and work together.
In terms of scrutiny on a deal, when did you see kind of like back of a fag packet analysis shift to being much more like Excel? I know you're laughing here, but like much more like Excel and specific, analytical skill set coming into kind of real estate?
That's when I joined CIT. CIT was a private equity business that had a degree of focus on financial engineering. They'd been very successful. More London's probably a good example, where they developed these assets and then securitized them and sold them off as bits of paper. But that's when I was first introduced to proper investment grade cash flows and working with analysts. They had separate analysts, a separate team who built and then maintained the cash flows with inputs from the asset management team in terms of the assumptions. And it was the first time that we've ever sort of knitted together financial engineering, or the first time I've ever knitted together true financial engineering experience from people who weren't even necessarily property experts, together with that sort of property background, and together working through the models. And some of them were very complex cash flows with sort of senior debt and mezz debt put in there as well to try and generate higher returns. We all know that back in the global financial crisis that didn't end well, but there's always still the opportunities that where you do put debt into deals, you can obviously add a little bit more in terms of your returns. So that was the first time I'd seen that sort of marriage come together. And CIT were very good at bringing those two disciplines together, because I think there was at the time some people who were very good at financial engineering and some people who were very good at asset management. And perhaps they didn't marry those two skill sets together.
And actually the benefit of coming through and being a chartered surveyor and understanding that like the property fundamentals is one thing, and then kind of taking someone from a bit more of a banking or a financial aspect who is clearly very bright and intelligent. They can learn the real estate piece quite quickly, but actually,
you'd be surprised. Sometimes they don't.
They need to like draw on your experience
Exactly.
in terms of actually where rents and yields and
very much so
sub-markets are actually going.
Yeah, I mean, as you grow within a business and as you become more senior and you become more experienced, then you start to have a greater understanding and even a feel as to where the returns should be, how you can generate those returns, and then it's working with the analyst to ensure that the cash flows. I quite often look at cash flows and I think that's not right. I wasn't trained as an analyst, so I go in and I sit with our analysts and we interrogate the formula. But I know when something is wrong, and we can have another look at that and really understand why it's going wrong and whether or not we've got our assumptions wrong or whether the cash flow is wrong. And as I say, the first time I really witnessed that was at CIT.
Talk to me about the move to HB Reavis, because you're kind of in quite an intensive asset management role, and then it's going to be a director of leasing. And obviously leasing is a key part of asset management, but it's only one facet of it.
So HB Reavis was an extremely interesting move for many reasons. I was asked to go and talk to them as their first UK employee. And at the time, the only person who really had any exposure to the UK was an individual called Thomas Yerdak, who I remain friends with today. And it was an opportunity that I felt was too good to pass up in terms of their appetite for growth, their appetite for risk. Again, it was that continuation of being able to apply a skill set that I've already learned, again, dealing with bigger toys, more zeros, which isn't an egotistical thing. It's just as you grow in your career, obviously you want to be generating bigger value and dealing with more product.
Yeah, stretching, challenging yourself.
Completely. But it was also the origination of deals. And one of the key aspects of it, which I found was probably the most appealing at the time, was it was almost an ambassadorial role as well, because HB Reavis weren't well known in the UK. We'd just closed on King William Street, which was going to be a knockdown and rebuild, and my primary role was to obviously try and pre-let that. And we were doing presentations we were almost trying to persuade sometimes brokers to come and talk to us. They were like, sorry, who's HB Reavis? So it wasn't just about trying to sell the product that we were going to deliver. It was about selling the credibility of that business as well, how we procured, how we developed. They had a track record, obviously, in Eastern Europe. And the strategy was to try and blend some of the best bits of how they developed in Eastern Europe with some of the best bits of how we develop in the UK and Western Europe. And, that posed some significant challenges, some of which were not easily overcome. But at the same time, it was being in the market and actually being a true ambassador, not only just trying to sell the building, but also selling the brand and to banks, to prospective tenants. And then, of course, as we were going out and trying to buy more sites, because the objective was to grow and develop more sites, it was also talking to vendors, because, of course, one of the biggest elements of selling a site is execution risk. Who are you going to sell it to, and are they actually going to follow through in the promises they've made to you in heads of terms for sale?
You touched on the business itself. It's kind of like an integrated model.
Yeah.
HB. Can you just expand on that? And also, for someone who doesn't know HB Reavis at the time, can you just talk on their legacy in terms of Eastern Europe and actually why they were moving to the UK and why they wanted to apply that model?
Yeah, I guess it was diversification for HB Reavis. It's a Slovakian business. They had a huge appetite for growth. They were very confident in the way that they procured and built buildings. Whether that was wholly correct for the UK, I think is still a work in progress, but obviously they have procured, built, let and sold a number of buildings now in central London. So, the proof has been that they've been able to divest and take profits from these buildings, thankfully one of which I was intimately involved in, which was King William Street. So as they continued to expand west, because obviously they were, the business was sort of conceived in Slovakia and then went to Czech Republic and Hungary, and then they made a bit of a leap to come to the UK, and then post the UK they opened up shop in Germany as well.
Did you not see it as a pretty big risk, taking a bet on a Slovakian investor developer? Yes, they've kind of expanded their footprint, but ultimately, an individual controls the business, I believe, or is it a family office or? They can turn the taps off quite quickly. So there's an inherent risk there in terms of making that move.
There were the appetite for growth and the risks, calculated risks that they were prepared to take to achieve that growth, and their track record in sort of Eastern Europe, in Slovakia. Yes, okay, they were a privately held company, so you didn't have sort of the same level of transparency. But I think given A, where the market was, B, their sort of very clear statement of intent, having gone in and bought King William Street, when there were other more established UK players looking at it, some of which tried to sort of poo-poo HB Reavis buying King William Street, and it was a site not without its challenges. Primarily because they were digging the new bank station upgrade directly below it with a shaft that was going to be sunk pretty much where the front door was. So there were those that were saying they'll never make it work, and whilst it faced its fair share of challenges, both in terms of construction and procurement, ultimately it was an enormous success, and now sits there on King William Street, having sold it to Wells Fargo, who bought it, I'm pleased to say. I think it was about 4 weeks after the Brexit vote. So that was a bit of a squeaky bum moment.
I bet. But in terms of you, though, taking that risk?
If I can see, having done due diligence on what I think the risks are, I mean, we all take risks every day. We're in real estate, so, we all look at risk-adjusted returns continuously. But in order to generate returns for our investors, depending on what the cost of capital is, we all take risk. So yes, there was a bit of risk in there. Personally, I think I actually liked the idea of being able to mitigate some of that risk as the business grew, and myself and some of the other people within the business were responsible for sort of growing the business, growing the team. And as we grew the business and we grew the team, we could see how those risks were being mitigated. You can't mitigate all risks, and indeed there were some risks that we were unable to mitigate, and indeed at some point perhaps for that incumbent team at that time became unworkable. But no, I'd sort of, if I look at and do my diligence on those risks, then personal risk is something that, as long as I can see that I can work through it and I can mitigate those risks, is something that actually I revel in.
The role was head of leasing. Can you just talk to me about that role and what it is that you did? Because I can only imagine, just based off what you've just said there, it's much more than just leasing.
Yeah, so again, going back to the product definition piece, because it was such a small team in the UK, I became embedded in the design team, which was led by John Roberts Architects. John is an incredible architect, and King William Street is just a triumph of a building. That's putting it in sort of flowery language, but it's an amazing building. And, HB Reavis should take a huge amount of credit for that as well. So it was really defining the product. Funnily enough, I was working quite closely with Core as well to begin with, who's a party who I work with very closely to this day. Being able to sort of filter into that product definition piece, the stage 2, stage 3 design, about what it is that the UK demands, what our customers, what our clients want, how UK lease structures actually, how they potentially impact how you're going to procure this build, and the sort of warranties and what it is that tenants and customers expect from a developer. Because signing a lease is all well and good, but of course when you're signing significant off-plan pre-lets, then your customers are placing significant degree of trust in you as developer, and they obviously have their own risks in respect to that development, and they want to be able to have those risks articulated to them by their own team, but also for the developer where it's all possible to mitigate those risks. Now, on a big pre-let, I've been lucky enough to close a pre-let in the last couple of years with Travis Smith. So where a developer can work with a client to sort of mitigate and lessen those risks, and of course they will, but of course we can't deal with every risk that a tenant may face in terms of signing an off-plan pre-let. So it was spending a huge amount of time both selling, because that's what leasing is ultimately, it is selling the space, but also really being the sort of the UK face, along with Thomas Yerdak of HBR. So that's what it was, a much broader role than just selling office space.
You were there for just shy of 3 years, and then Ivanhoe Cambridge came knocking. You said you've got a story about how that came about.
Yeah, actually, so I went to Lendlease for a couple of years post HB Reavis, and it's interesting with HB Reavis that the team that managed the business in the UK sort of set itself a goal, I did anyway personally, of seeing 33 King William Street through to an eventual sale, both in terms of my own personal satisfaction, and obviously I was going to be remunerated on a successful outcome of that deal. So I was very pleased to say that was we managed to close that deal, as I say, a few weeks post the Brexit vote, which that was a real squeaky bum moment. But and then I was approached by Lendlease to go and look at and help them with IQL, which was another new challenge. It was a campus challenge. It wasn't quite as core, shall we say, or in the core. Clearly, it's an East London campus, and that again came with its own challenges. But that again was a director of leasing role, but it expanded considerably into a role that was around product definition and working with Lendlease. Lendlease obviously is a big global brand and has a lot of credibility behind that brand. But again, it's talking to people about, and it's the first time I'd ever dealt with talking more about well-being and campuses and the space that binds the buildings together, not just talking about the buildings themselves. So again, when I referred back to, or I was talking earlier about what you think you're going to learn or what you have learned, I like to reflect and also look forward. Going to Lendlease was something new for me to learn about, talking about offices and real estate in a different way to how I potentially did at HB Reavis, where it's very focused just on the building, whereas this was focusing a lot more on the place.
And the curation and the other parts of what drive an overall return.
Completely
things
right.
You've got to incorporate, whether it's F&B or...
It's all, I mean, people talk about it now in terms of experience,
yeah.
Amenity, is it amenity rich? How are my people going to feel within the space? How does that contribute to their well-being? When I say space, I mean the indoor and the outdoor as well, because IQL was a neighbourhood as such, rather than just the development of a single building.
Do you consider yourself restless when it comes to some of the moves? Because I know you've had a few short moves. Is that, and I know people don't have kind of 30-year careers in one particular company anymore. Do you see, those moves as an opportunity to kind of go, learn, have an impact, acquire a certain skill set, but you've just got an insatiable appetite just for kind of like professional development and learning and stacking all these different skills? Because it's very logical and it makes sense why you've made the moves when you have, and the kind of different skills and the facets that you've kind of put into your armoury at each move.
So there are different elements to it, and we're all human beings at the end of the day. So if there is some changes in personnel within organisations and perhaps you don't fit with those changes that happen during your period that you're within those organisations, then clearly that can lead to matters becoming unsettled. But I've always looked back and thought I've been able to achieve what I set out to achieve in each of the roles that I've had, and then partially through, or predominantly through my own making, but to some degree a bit of luck, and we all need a little bit of luck, that the moves have happened as well at times that have really suited my career progression. So yes, HBR was there for about 2.5, 3 years, and it was a really good time to move on from HBR, having just closed 33 King William Street and moving on a high. And then with Lendlease, there was the opportunity to potentially go out and I actually looked at doing something for myself for a little while. But then a headhunter who I was working with quite closely to introduce me to different sources of capital, not in terms of fundraising, but just going in and doing almost like white label asset management. Just approached me one day, he's still a friend to this day, and said, do you fancy a job? And I thought to myself, I'm not sure I do. I quite like the idea of doing something for myself, being my own boss to a certain degree. And he said, no, I really think you should go and talk to these people. And so I went home and spoke to my wife at the time, and she said, no, I definitely think you should take a job. So I went off and had a chat with Ivanhoe Cambridge, which had some relatively similar characteristics to HB Reavis insofar as they had big exposure to, similar characteristics insofar as they already had big exposure to the UK, whereas HB Reavis was trying to grow their exposure. But I was going to be the first UK employee for Ivanhoe Cambridge for some time. So again, I'm quite comfortable with turning up in an office on the first day. And first day at HB Reavis, I turned up, I was the only person in the office. First day I turned up at Ivanhoe Cambridge, I was literally the only person in the office for Ivanhoe Cambridge. So, and that's something that I'm to some degree comfortable with, because I'm confident in my own ability to get on with it, and I'm very comfortable in my own ability to where I have autonomy to do so, to make decisions and move forward.
What was why were Ivanhoe Cambridge expanding over here, and why did you fundamentally join the business, and what was your remit?
Ivanhoe have always had exposure, well, I say always have had exposure to the UK for some time. They perhaps have not had the same level of public prominence as perhaps some of the other Canadian investors, but they've generally done investments through partners, operating partners, and there was a move to try and just influence the direction of travel a little bit more in terms of some of the assets that we already owned, and indeed have a bit more of a hand on the tiller in terms of the acquisitions that we were looking to make. So I joined, and about 3 months later, a colleague of mine who's head of investment in the UK joined as well, a guy called AJ Full. So we were there primarily we had a portfolio of office assets that were performing very well, but we wanted to sort of continue to grow those assets and potentially look at an ultimate exit on those assets. We had another asset, Stonecutter Court, that had not quite gone to plan in terms of it was underwritten as a core plus acquisition, which effectively meant that the underwriting at the time of acquisition was to re-gear and renew the lease with the tenant, which didn't happen. So we were facing huge void exposure there, and indeed significant capex risk as well, because the business plan had pivoted towards re-gearing the lease with the tenant towards either a significant refurbishment or indeed a wholesale knockdown and redevelopment.
You touched on working with operating partners. Would they invest in assets directly with operating partners and then build platforms?
There's many different ways to skin that cat. I think the way that we tend to operate is that we have sort of assets where we have 100% and have full control. We then have assets where we have sort of, which we call semi-direct, where we have control, but we work with operating partners. And then we have obviously discretionary funds that we invest in, the likes of some of the bigger US managers. But we tend in the UK, the assets that we look after directly are either direct or semi-direct investments. And yes, the operating partners, some of our operating partners will put some equity in, 5 or 10%. but we still like to have overall control of the strategy and the direction that these assets go.
And that enables you to have quite a small, lean team.
Exactly. It's
on
about
the ground
resource.
here.
Ultimately, it's about resource at the end of the day. It's about being able to turn on and off that tap when you need that resource, but also working with good people. I mean, I'm pleased that I've been able to hire someone just recently, but that was quite a long and complicated process. So finding the right talent at the moment is incredibly difficult for numerous reasons. So with working with trusted partners, you can access that talent without actually having to go into the market and hire it yourselves.
Next time we'll make it much more easy and much more enjoyable to hire a top performer. So make sure you give us a call next time. So how do you go, or how does one go about working with Ivanhoe Cambridge? Yeah, from an operating point, how do you form that joint venture? How and what do you look at? Because I appreciate it's obviously the deals that they bring to the table, but it's also the quality and the credibility of the partnership or the team behind the operating partner as well.
Yeah, so I guess I can only primarily speak for the UK, although we have partners that we operate with globally, some just within Europe, others just within Asia, and others just within North America. But with some of the larger partners, that relationship is a global relationship, whether it's with Blackstone or Hines. But in terms of the way that we've historically operated in the UK, although the UK team has grown since myself and AJ joined, we're now 7 as opposed to 2. So we are bringing in more and more resources. The portfolio sort of matures, and we take on a little bit more in terms of the direction of travel that we want to go in. But no, we've tended to work with office operating partners where they have brought the deals to us. Whereas now we tend to be a little bit more stand on our own 2 feet in terms of originating deals. We would operate with residential partners. Actually, Greystar, one of our biggest residential partners who we have a sort of global relationship with, they would bring us deals and then put equity into the deal as well. We put it into a sort of GPLP structure. PLP, who we do most of our logistics with in the UK, which is a developed core fund, where again that was brought to us actually by Macquarie before I joined, and that is a platform where we actually invested into the manco of the business, as well as actually providing the majority of the equity funding for the deals themselves. So we can skin that cat many different ways. I think at the moment, in terms of because we're quite a thematic investor, we are a pension fund as well. So whilst we're happy to look at risk, and in the UK we tend to move a little bit higher up the risk curve than perhaps we would do in other geographies. So we will work with operating partners within our existing portfolio, where we might bring an operating partner in to fulfill a skill set that we can't resource internally. So probably a good example of that is a couple of big office developments that we're looking at the moment, one of which is coming out the ground at the moment, which is Stonecutter Court, where we're working with Core as a delivery partner rather than sort of a true operating partner. And that's a relationship that we really value. So that's one way where we actually go out and source the operating partners ourselves. And we pride ourselves both, the whole of the UK and European team pride ourselves in actually knowing a number of partners of who to approach, depending on the characteristics of the deal. Obviously, we have partners who bring us deals as well, and this is an evolving space where there's always new people who are setting up, and you've probably had some on your podcast who've set up as operating partners, having come out from bigger shops and are now looking to bring deals and source new opportunities with funds like ourselves. And they're really quite interesting people to talk to, because whilst they might not have that sort of track record, they've got that track record within their previous shops, but it's also that degree of enthusiasm and the different skill set they can bring to it. Because I think the way that we look at real estate is ever evolving in terms of how we provide that service to our clients. What are the characteristics? How do we talk about real estate nowadays? What's the key drivers of value? What are our main pillars when you look at Ivanhoe Cambridge? And yes, we're here to generate a return for our investors, but the ways that we might look to generate and the levels of those return that we might look to generate in consideration of some of the challenges that we face at the moment may be different. And I think some of the younger operating partners actually look at that with through a slightly different lens than perhaps some of the more established operating partners.
I guess you can de-risk it in a sense. It's given your understanding, the house's understanding, and there's different ways of structuring and rolling up the fee, so there's benefits for the operating partners.
But you can de-risk, and then you can actually potentially end up taking a little bit more risk as well, because actually procuring and buying a development of several tens of millions, if not hundreds of millions of pounds, is a skill set that actually is rarer than you might appreciate. So whilst you could find yourself working, or go and find an operating partner that perhaps looks at it through a slightly different lens, they still need that core skill set, if you'll excuse the pun, of actually being able to buy and build these buildings. And building, whether it be sheds, offices, built to rent, it's a very complex and quite risky thing to undertake.
How do you get comfortable personally on the individuals that maybe have been at other shops who've left to set up their own businesses? How do you get comfortable with them and their ability, without the track record, to actually show you that they can take pension fund capital and deliver a return and liability match it?
That's a very good question. I think so far we've probably erred on the side of caution and gone with more established operating partners just to date.
Yeah.
For some of our office developments, and then for our shed development, it's been with a group of individuals who've got a wealth of experience. So I think it's perhaps the way the world is moving towards. It's just whether we perhaps haven't sort of gone in that direction just yet, but it's certainly something that's on my mind. I talk to, again, a few of these characters will have been on your podcasts in the past, but talking to people who are new entrants into the market. But it's not, you're a bit chicken and egg, isn't it? You can only create your own track record if someone's prepared to actually invest with you. So what you need to look at is, what have they achieved elsewhere? For some of these parties, they would have been at relatively big shops, and if you look at what they achieved within those big shops, it's considerable. So if I was to go to investment committee and recommend a partner, it's not just what have they achieved within their new shop, or what have they achieved throughout their career, and indeed, what do they stand for, and where can they add value ultimately, not just in terms of numerically, but what's their stance on ESG, and the E and the S and the G, have all, the G doesn't get talked about as much as perhaps it should do, but governance is of huge importance, especially to us as a global pension fund.
Could you just expand on the G bit? Because we've had quite a few people on the podcast who've obviously spoken about the E an awful lot. We've also had some a little bit more recently on the S and the impact element. Talk to me about the G part.
So the G is difficult to quantify from a financial aspect, but it's about how they govern themselves. What do they stand for? Is that governance of sufficiently high quality so that we can actually get comfortable with the risks that may come from that governance? I don't think we've ever had a situation where we've had sort of any particular issues with the governance of a partner, but the property press does like to run some stories every now and again, and we're very focused not only on the financial return that we generate for our fund holders, but also the reputational risk as well. So we don't necessarily want to be investing with people who are going to potentially take us in a direction that we perhaps don't want to be in terms of the G. I do think the E and the S are perhaps slightly easier to quantify, especially as we evolve into these spaces. The E in particular is becoming easier to quantify in terms of the financial return that we will see from the E. I I think it's more about liquidity at exit rather than sort of day one value add, and whether tenants will pay you more rent for a building that has these sort of exemplary ESG characteristics. I think it's more about that you're going to see this brown discount emerge, and whether or not you can even lease or sell buildings that are considered to be brown or stranded. So it will just be a delta between the two sets of values.
We spoke off mic around a concept called the green IRR. Can you just expand on that? Like, what is a green IRR and how do you see that?
I mean, we've been looking at, as all of the big funds have, in terms of what we can sort of truly add in terms of our own ESG commitments moving forward. And, it's clear that as we develop these new buildings and we move towards sort of net zero carbon, there is a considerable amount of commitment in terms of potential capex. And we have a cost of capital, and we want to try and achieve and exceed that cost of capital. That's the returns that we sort of promised our shareholders. But if we can blend some of the returns that we need from that capital expenditure with what we call a green IRR, which will be a lower IRR, to reflect the fact that it has a greater degree of social benefit rather than just financial benefit, then perhaps we're going to be able to blend and look at a slightly lower, this is something that's still work in progress, but a slightly lower cost of capital for the deal as a whole.
But net there's a much more positive benefit, and then in terms of the ease, in terms of raising capital, and building the business,
a very binary example. If you wouldn't do it now anyway, but let's just give a binary example. If you were looking at building a new office building, it's probably cheaper in terms of your financial commitment day one to buy boilers than it is air source heat pumps. But everyone would want to, and even now to comply with planning legislation and the life cycle carbon analysis that you'll have to undertake to get your planning permission. It would still be cheaper to buy boilers, but people know that you simply wouldn't buy boilers. In my opinion, we wouldn't buy boilers now. Perhaps wouldn't even buy an office building that was serviced by gas-fired boilers. But the capex requirement to buy air source heat pumps as opposed to boilers is higher, and therefore can you attribute a slightly lower return to that capex element than you would have done otherwise.
Ivanhoe Cambridge, obviously, pension fund, long-term view, index returns. You touched on the CIT a bit more, private equity model, in and out. How do you manage risk, and how do you allocate different pots of capital to maybe a bit more kind of like value-add deals compared to core, longer-term, secure income deals as well?
So if we look at it on a purely UK basis, we have probably more money invested at the higher end of the risk spectrum. We do a lot of development through partners in the UK, and then that is blended with deals that we will do elsewhere, and indeed existing portfolios that we'll have elsewhere, potentially in North America, Canada, Asia. We as a business have always been quite proud of, and I think historically quite focused on development, especially in Europe and Asia and the UK. And we sort of blend that with retail portfolio that we have. We have a huge legacy, which we've been able to divest some of, legacy portfolio of retail within Canada, which has certain positive characteristics. And then we're not going to be sort of too ashamed to say that it has some negative characteristics as well, given the challenges that the retail market has faced over the last, many years now. So the appetite to risk is on a risk-adjusted basis. We want to find that right balance between sort of value add and opportunistic. We tend to look in the UK, if we're going to do develop, it's developed core, so we can then potentially recapitalise those assets and keep some equity on the table and clip off the income from those assets. Or we may look to, once we've executed the business plan, is divest those assets completely. Probably the best example of that is Minster Building, that was bought with Greycoat, which is an operating partner that we work with quite closely over a number of years, and we worked through a business plan of repositioning and leasing, and then decided to divest that asset purely because we felt it was the right time, both in terms of the market, but also the right time for us to reinvest that capital, take that capital and reinvest it into elsewhere, because we felt we could generate higher returns by taking that equity out of that deal.
As we sit here today, middle of June, can you just give me a bit of an overview of the UK portfolio, just in terms of some of the numbers, and in terms of where the capital is allocated as well?
So at the end of Q1 2023, we were looking at a portfolio valued at around 3.3 billion Canadian dollars. That's made up of actually quite a broad cross-section of assets. We are a partial owner of Easy Hotels that we took private. We have quite a significant exposure to logistics, office, and residential. But we've also been able to close throughout the second half of last year some fairly imaginative deals with Airmont Capital, where we were quite a significant investor into a fund that invests into film studios. So relatively broad cross-section, and indeed the focus looking forward will potentially be more around, as a lot of investors, the traditional sectors being beds and sheds, with a focus to look at perhaps a brown to green strategy in terms of offices, but definitely a focus as well on some more alternative strategies.
That leads us probably quite nicely as we draw to a close this conversation. The question I ask everyone on the podcast is, if I was to give you £500 million of equity, I know that's a drop in the ocean for some of the stuff that you guys are managing. Who are the people, what property, and which place would you look to deploy that cash? And of course, you can have your team. I'm going to push you a little bit to kind of maybe think a little bit broader. Is it that brown to green strategy?
I'm going to be a little bit contrarian in terms of the house view. And in fact, you might expect me to say this because of my experience with offices, but I do think that the brown to green strategy, if you can find the right product with offices, is something that, given the acute lack of stock and the development pipeline that's coming through in 25, 26 for central London offices, and the laser sharp focus that clients have on assets that do have these exemplary ESG characteristics, not just operationally, they're also looking at the embodied carbon within the buildings as well, which again sits with the brown to green strategy in terms of not knocking these buildings over any longer, but repurposing and remodeling buildings. I do think that is a sector that I can see some potential returns and value add in that sector. If I had, let's say I'll stick 250 million into that, another 250 million. I quite like some of these alternative sectors that we're looking at the moment. I think build to rent, if you're looking for income return and you're prepared to take development risks, so you can sit on yield on cost, is still quite attractive given the, again, very acute lack of supply that the build to rent sector, especially in West London where we're developing at the moment, is suffering. And again, having been around some of these film studios that we've just recently invested in, where I was lucky enough to tour some of the sound sets just from a personal experience. Hopefully they'll make lots of money, but the whole experience of walking around these was truly incredible.
It's content, isn't it? There's
content is king.
Content is king, as well as cash flow, and that's, I guess, what we're doing today. But Richard, thank you so much for joining me on the podcast today, sharing a little bit about your background, some of your learnings, how you've kind of navigated your career, stacked a lot of different skills, and how you've applied them in your existing role, and also what you're doing at Ivanhoe Cambridge. Excited to see what you and your operating partners and the wider business go on to do.
Cool. Thank you very much.
Thanks. Thanks for listening to this episode of the People, Property, Place podcast. If you found it insightful, feel free to share it with a friend or colleague. Subscribe, give us a rating, like or comment. It helps tremendously. It'd be great to hear from you on LinkedIn. I'm super open-minded to recommendations of guests we should get on the podcast or areas of the market we should explore further. So do drop me a message. The People, Property, Place podcast is powered by Rockborn. The team recruit experienced talent for investors, owners, developers, and operators. So if you're considering your career options at the moment or looking to attract top talent to work for you, head over to the website www.rockborn.com, where you can find a wealth of research to aid your search. Have a great day wherever you are, and I look forward to catching you next time.